Hello everybody, this is Don Brunner coming to you today with a little bit of information on cash flow statements. Sometimes a little bit tricky, but most often very handy. So let's move on. Okay, first let's take a look at the format of what a cash flow statement looks like. Basically, we're talking about 5 different parts. Cash and cash equivalents from the beginning of the period. That period can be a year, a month, a quarter, whatever you want. Cash generated from operations. Cash flow from investing activities. Cash flows from financing activities. And cash and equivalents at the end of the period. Now, these items all come from both the income statement and from the balance sheet. So as we go through, we'll take a look at these a little more in depth. First step in this process is to figure out where a company left off in the prior accounting year, or month, or whatever period we're working with. This will be the beginning balance for the current year. The value can be found on the company's prior statement of the cash flow, or on the company's balance sheet, or it's possible to calculate the beginning value for cash. Cash and cash equivalents are a current asset of a company, and this value can be found by looking at the company's balance sheet. This value can be calculated by adding cash, money market funds, certificates of deposit, savings accounts, and similar types of deposits. In general, this is a current asset that can be readily exchanged for goods and services on a short notice. In this example, we're going to start the company with $6 million at the beginning of the year. Okay, now we've moved into slide 4, and we're going to look at cash from operations. Next thing we're going to look at for generated by the operations of the company, sometimes referred to as the cash provided by operating activities. To calculate the cash provided by operations, we need to start a starting point, which is the net income. Again, that's coming from the income statement. One of the advantages of evaluating a company on a cash basis is that it's not subject to the accounting methods that prevent analysis from getting a clear picture of a company's financial health. Unfortunately, net income does include some of those accounting adjustments. To truly understand the cash generated from operations, it's necessary to remove from the net income the value of what are called non-cash transactions. Okay, what are those items that are not affecting the cash? Well, the most common example of a non-cash transaction is depreciation. There are 2 classes of adjustments to net income required to calculate cash from operations: depreciation or amortization of assets, and the net changes in the current assets and liabilities. If a company claimed depreciation expense in their income statement, that value needs to be added back. Likewise, if a company had an increase in accounts receivable, that value needs to be subtracted from net income. We're trying to figure out how much cash exchanged hands throughout the year. A company that might have sold more goods and had a rise in accounts receivable, but until that money is received, it's not considered cash. Now, in the cash from the operations example, we're going to see how the concept would be used in practice. In the example, the company had a net income of $8 million. The depreciation expense was $4 million, while the accounts receivable went up by $2 million, and the accounts payable went up by $1 million. The above example, the non-cash expense depreciation would be added back to the net income, since the money never really left the company cash accounts, while a rise in the accounts receivable, money not yet received, needs to be subtracted from the net income. The company is still owed the money from the customers. And if you remember on the income statement, that net income figure is generated from sales, and whether you collect the cash or not, the sale is recorded. We'll see this a little more clearly when we get to the filled-in form at the end of this lesson here. By that time it should become a little more clear as some of the numbers were batting around. Next, we'll take a look at the cash flow from investing activities. The next step in building the cash flow statement is look at the money the company spent on new capital investments. If a company capitalizes an investment, that outflow of money does not show up on the income statement. That's because accounting rules allow the company to depreciate or expense the cost of the investment over time. From a practical standpoint, if a company purchases an asset such as new plant and equipment or machinery, then they very likely paid for the asset with cash. When the money leaves the company, there's an outflow of cash that needs to appear on that statement. Normally, a company might show one line item for the capital investment and label that line item as additions to plant. In the example, we're going to show these purchases as separate items so that you can follow them through. The section of the cash flow statement shows money that left the company to pay for the assets. The information doesn't show up on the income statement because they're considered investments. These investments will be depleted over the useful lives, either through depreciation or other capital accounting adjustments. As this occurs, that's when these investments appear as expenses on the income statement. The final category of adjustments to be addressed on a statement of cash flows is money raised by financing activities. As was the case with cash from operations, it's possible to have both positive and negative adjustments to cash flow depending on the financing activities the company engaged in during the year. The typical adjustments appearing in this section include changes in long and short-term debt, issuing and redemption, issuing of preferred stock, issuing of common stock, retirement of stock, and stock dividends paid in cash. Now, the final task that we have involves calculating the ending cash balance for the company. This involves adding all of the prior adjustments to determine if there was a net increase or a decrease to the cash. The value, either positive or negative, is then added to the starting balance to derive the ending balance. Well, that's pretty much it. Now we're going to take a look at the completed sample, see if we can work our way through it, and I think you'll find that if you do this a few times, some of the vagaries may kind of clear up and become a little clearer to you. Here we have the completed sample form of the cash flow statement. Most of it is fairly evident, and most of it was included on the previous slides. The real trick, though, is determining the sign, whether it's added to or subtracted from. In my own mind, I have kind of a little trick that I use. The good things that happen when you get cash, the sign of those are positive. When you're dispersing cash, you're paying it out, that's a bad thing, and those signs are negative. So when you add them up, you'll come back to the bottom. Again, remember that you're probably only using this because you're a corporation, and that's because corporations really are mandated to justify and reconcile their numbers. But small businesses too that operate on a cash basis can benefit greatly from using this thing on a monthly basis and projecting out their balances. We have a form that you can use that'll do that. If you'll call the office at area code 626-447-8829, you'll see that you can get one of those forms, and you'll find it very helpful and very useful for your needs in cash forecasting.